The real problem with today's stock market? The biggest problem with today's stock market is not simply that stocks are expensive. The bigger problem is that the market no longer behaves the way it used to. In the past, the stock market was easier to understand. When corporate earnings improved, stock prices usually went up. When interest rates rose, the stock market usually felt pressure. When the economy weakened, investors usually became more cautious. Of course, the market never moved perfectly according to these rules, but there was at least a basic logic behind price movements. Today, that logic has changed. Now, liquidity, passive investing, the options market, algorithmic trading, and investor psychology often move the market more strongly than corporate value itself. That is why we see strange things happening in today's market. Stocks keep rising, even when companies look expensive. Investors keep buying, even when earnings expectations seem too optimistic. Large technology stocks continue to move higher, even when interest rates remain elevated. The market looks risky, but pullbacks are short and rebounds are fast. Some people describe this market with a strong phrase. Today's market is like a digital casino. The phrase sounds extreme, but the meaning is clear. The stock market is becoming less like a place for long-term valuation and more like a game where people bet on short-term price movements. There are three major forces behind this change. The first is passive investing. Today, a large amount of money does not enter the market through individual company analysis. Instead, it flows into ETFs and index funds. When this happens, large companies inside major indexes keep receiving money regardless of their individual valuation. The bigger a company's weight in the index, the more money flows into it. As that company's stock price rises, the index rises. As the index rises, even more money flows back into the same large companies. This creates a self-reinforcing cycle. The second force is the options market. In the past, the market was mainly driven by buying and selling stocks. Today, short-term options trading has become a powerful force. Short-dated options can make market movements faster and more aggressive. When prices rise, more bullish bets enter the market. Those bets can push prices even higher. But when the market falls, the decline can also become very sharp in a short period of time. The third force